We're not traders, we're long-term investors. So from our perspective, we're just going to hold this with the anticipation and the understanding that we will almost certainly get pullbacks here. Whether we get it tomorrow or in 2 months' time, I don't know. And I don't particularly care, because I'm interested in the long-term trend. I'm interested in where things are likely to be 3 to 5 years out. When I look at it from that perspective, gold equities are still cheap. Gold itself is still cheap.
You're watching CapitalCosm. It's October 14th, 2025, and my guest today is the publisher of Capitalist Exploits Insider. It's Chris Macintosh. Chris, thank you so much for coming on the show, my friend.
Pleasure to be here, mate. Good to be back.
Yeah, likewise, Chris. We always enjoy hearing your insights, and like I mentioned in the intro, you are the publisher of Capitalist Exploits Insider, my favorite newsletter. I have been a member for over 5 years now, since 2020. Chris, thank you so much for coming on. Let's go ahead and dive right in to the action. But quick note before we do so, we do have a special discounted link in the description box for CapitalCosm viewers to get $1,000 off the Insider newsletter. That's Chris's newsletter. So if you're interested, be sure to take advantage of that. Chris, precious metals are running hot. Silver actually reached $53 in overnight trading the other night, but then was slammed back down to just around $50 to $51 today. Gold is still north of $4,100. What's your take on this recent, very extraordinary move in precious metals?
I think it's, Danny, part of what we've been discussing for some time, which is a capital rotation. One way to look at the rise of price in precious metals is also the fall in price of fiat currency, right? There's that age-old saying, which is that gold is money and everything else is credit. So what's happening? Well, credit is falling as a consequence of gold being primary money, and so it's. We're simply watching what we've been talking about for some time, which is to say that we are in a period of time whereby you go through geopolitical conflicts and you have a monetary reset and a rotation of capital from credit-based assets and into, well, we believe into commodities, but and that's typically what happens. So I think we're in, I don't know what innings, maybe sort of second, third innings of a 5 innings game. In that, gold has moved, but gold's outperformed for 2 years. It's outperformed the Nasdaq for 2 years now. But it's only of recent that the miners have started moving, right? And silver and platinum and palladium and even now copper, those have all just been recent moves. Okay. So there have been recent moves on the back of gold powering ahead even more strongly. So what do I make of it? Well, I'm far from bearish. I've made the point before, which is to say that the vast majority of the capital that's been deployed into the current gold bull market has not been from retail or commercial. It's been from sovereigns. And so that leads you to at least believe that there is still the ability for it to continue to power higher, i.e. there's more fuel to be poured on this particular fire. With that being said, there is more support coming in from institutions and a little bit from retail. But again, it's still fairly small. I believe that it's going to continue in its current trend, albeit with pullbacks. Just before we jumped on the call, you were saying, what would you buy here? Do you buy more gold or gold miners? I'm of the opinion that you buy what people don't want to be buying in this trend. And so if we're correct in the capital rotation belief, then you would buy things like energy now, as opposed to silver or gold or platinum or.
Gotcha. So here's an interesting chart. This chart on its own is XAG, which is silver. This is a silver chart. This goes all the way back to 1802, so 200 plus years of data. Now, if I juxtapose the oil price right on top of the silver chart, you can see this. I mean, they pretty much track one another. There are times when there's a bit of a lag between one versus the other. But what you'll
Mhm.
notice is right now there is a bit of a disconnect between the silver price in yellow and the oil price in blue. So, if one could make the case that if the correlation that's been with us for over 200 plus years is likely to stay with us, one of two things have to happen. That is, number one, the silver price has to come down to meet oil at somewhere around this level, around the $20 mark, or oil has to try to catch back up to silver. And that takes us to around what, $140 oil based on this scale, something like that, or maybe something in the middle where silver comes down and oil goes up and they meet
Mm.
somewhere in the middle here. But if it were you, if from your analysis of past markets and so forth, which do you see? Which scenario do you see being more likely? Does silver come down or does oil go up?
Well, look, here's another. I'll answer the question another way. Ultimately, prices of an asset should come about as a consequence of one or two things, or both: revenues, right, profitability,
Mm-hmm.
and the second one, if it depending on, well, the fundamentals of that particular sector, i.e., if there's a shortage of supply or an excess of supply, or a shortage of demand or excess of demand, those on whatever the particular thing is, whether it's straw hats or baby lotion, doesn't really matter. The same thing applies. So those are, when we look at that, when I look at like the energy space from that perspective, then it's quite clear to me that where I would want to be allocated. It's interesting that we just had Jim Cramer, Jim Cramer, bless his
Oh
socks, coming
yes.
out telling us that the oil's done. I'm trying to think what his statement was. He said there's no more money to be made in oil and gas stocks, and we're on the death knell phase. So, um, which I find quite interesting because we don't have. Again, when I come and I look at the profitability of these companies, um, the supply and demand. I mean, we could add in the whole metric with respect to AI data centers, and which is crazy, and the amount of energy that they require and are acquiring and sucking up, and the acknowledgement now that we don't have it. So, where are we going to get it? So the
Mm-hmm.
idea that oil and gas stocks or any energy stocks, including nuclear or coal, are a bad investment. It's odd to me because it's sort of juxtaposed against this massive mania in AI, right? Um, Very odd because you can't, like, logically you can't be fully bullish on AI without acknowledging that AI requires immense amounts of energy. And then you would logically say, well, where is that energy going to come from? But markets are not logical; they're emotional. And Kramer's a clown, so um, there you have
I,
it.
I will say I've got to give him credit. He timed his post to literally the day before we had this pretty big sell off in gold and silver. I believe it was on Friday, and then rebounded because we had that market scare on Friday and then rebounded on Monday. But nonetheless, he sent his post out on Thursday, and then you had this big sell off in everything, but everything including gold and silver.
Yeah,
So I have the Huey index, which is a gold mining index. And as you can see, we have run up quite a bit from the bottom here in 2023. I want to say about 250%. But when you look at this thing from a long-term lens, I mean, we are just back at all-time highs that we last saw in 2011. Now, in 2011, the gold price was much higher, or sorry, much lower than it is today. It was about $2,000 compared to the $4,000 that it is today. So, have the mining stocks overheated here a bit? Are we due for a pullback? Or when you do look at this, at least from a ratio perspective, 2000, we're back at price levels that the index was at $2,000 gold. Now at $4,000 gold and rising, should we anticipate this to continue moving on up?
Yeah, it was. I'll just preface the answer with this. I think it was maybe a year and a half ago. We wrote an article. We pointed out how the miners were the cheapest that they'd been on a free cash flow basis in something like 40 years. So again, forgetting about price, right? People get concerned about price and they look at just the price of something and they go, oh, it's expensive or it's cheap. But that's not always an accurate methodology, which is why we have things like PE ratios, right? To try and determine whether something is actually cheap or expensive. So we had this setup where they were the cheapest that they've been on a free cash flow basis, which is to say that they're profitable. Okay. And that was back when gold was, under 3,000, I think it was. And so what you're obviously going to have with any company that's mining a resource which has gone up a lot in price is that you get margin expansion. So they become more profitable as the price rises, which is of course, and then they often, not always, but often have leverage too. So you'll have a bigger move in the equities than you do in the underlying spot price of the commodity, whatever that commodity is. Could be tin, nickel, gold, you name it. So when we look at it from that perspective, it's not very expensive. That being said, we've had whenever you get a price chart that looks like a very long green candle, that's like, if you're a trader, that's not a time that I would be particularly excited about something. We're not traders, we're long-term investors. So from our perspective, we're just going to hold this with the anticipation and the understanding that we will almost certainly get pullbacks here. Whether we get it tomorrow or in 2 months' time, I don't know. And I don't particularly care, because I'm interested in the long-term trend. I'm interested in where things are likely to be 3 to 5 years out. When I look at it from that perspective, gold equities are still cheap. Gold itself is still cheap. And so that means that I will continue to hold my positions in those sectors. I might trim some things, and that's a matter of just position sizing and portfolio management. But there's we're still in the early-ish phases, I believe, of this monetary cycle change. But as you pointed out before, Danny, the more interesting things to us are the stuff, are the things that have yet to move in a capital rotation, and that's where the energy space is just glaringly obvious to me, and very exciting.
So expand on that. What particularly in the energy space excites you?
Gosh, where do I start? Well, if we take oil and gas stocks, which by the way are what Kramer's just said is dead. And if I just look back for over the last 3-4 months, Brad and I were doing this the other day, oil's been down about 9%. And the S&P's up about 8 or something. So we kind of had this sort of divergence between the underlying. Well, firstly, the broad market, being the S&P, has gone up, right? So capital's going into that. Secondly, the price of oil's come down 8-9%. On the back of that, if I said to you, Danny, what do you think would have happened to the oil and gas stocks? What would your guess have been?
I would have thought they would have traced the price of oil.
But they're up about 13%. And the reason I think, and these are the sorts of things that we look for, is that your you will often find uh, you have these bottoming processes where there's well, how do I explain this? There's a disconnect in terms of the internal market between the underlying, say, copper, gold, oil, it doesn't matter, and then the equities in that space. um, and and it's in it. I don't know if it's just the markets being smart and understanding ahead of time. Time will tell. But I've seen this many, many times before, especially when you have very long-term bottoming processes and you have an unloved, sort of hated sector. And absolutely, oil and gas falls into that, like 100%. So we're seeing that taking place now. And so that gets me pretty interested. Then the other factor, and we talked about this many times before, is that many of the companies that we're looking at, so things like in the offshore space, that have been through debt restructurings and so on and so forth, are the the sellers. The sellers have gone away, and so it's like a bull market. There's a saying, well, what happens when there's no more? Um, what happens when people come to sell? And that's actually kind of not really always the answer in a bull market when it turns into a bear market, because you have all these continuous buyers, but it's like when in order to have a market keep moving higher, you have people think, well, you need to have more buyers, but you could just have a stable market where nobody does anything, right? And the last price traded is the last price traded. Of course, that's never going to happen. But it's ultimately when you have when there's no more sellers, right? Um, that are prepared, like when you have a market where the the sellers are selling into rising demand, okay, and that rising demand starts shifting to, say, like an equilibrium point, but you still have sellers, okay, that can then bring the market down. On the flip side, on the other side, which is, I would say, is like in the oil and gas space, there's just no more sellers, okay. So everybody that's going to sell has sold, and so now it just takes in tiny incremental buying that lifts the prices up. Okay. Those structurally, that happens in 10, 15-year bear markets, right? Just simply because everybody is exhausted. So they sell everything and they're gone. There's no more sellers. And those who are still holding now are either your sort of died in the wool bulls on whatever that particular asset class is, or they're newer buyers and they've already taken their positions. But by and large, you don't really have anyone left that's going to sell. And I think that's structurally where that market is at now. So, and then I can add in all the sort of geopolitical problems that we've got going globally, and we could talk about that for some time. But by and large, that's structurally, I think, where the market is at. And to the point of the charts that you got there, they all, over a long term, they'll mirror each other. Whether it's oil
Yeah.
versus silver.
Yeah, so the top chart, just for the commentary for the sake of the audience, the top chart is the OIH ETF, which is an ETF of oil service companies, and the bottom chart is the oil price itself. And what you'll notice is sometime here there was a disconnect between both charts. So you'll notice here around June, I want to say June 20th.
Yeah, like
You
3 months ago.
Yeah, June 20th, the oil price started to, got up, began a downtrend, whereas the oil service companies started moving up ever so slightly. So a disconnect, like you said, between the oil and gas companies and the commodity itself. And interestingly, this is about a week into the 12-day war between Iran and Israel.
which you wouldn't like if I said to you, we're going to have a war against Iran. What's the price of oil?
Yeah.
What would your guess have been, right? It probably wouldn't have been lower, but here we are. So, I mean, a lot of this comes down, like we talked, I think it was last week or the week before, on concentration, right? Concentration of capital risk, and so you get a similar thing on the bottoming of a market. So just like in the topping of a market, you have concentration of capital, typically in fewer hands and in fewer players, which happens in the .coms. It's happening today in the Mag 7. You get the bottoming in a market in the same. You get the same sort of concentration. So you can imagine, for example, that you got, let's just say, 100 companies that are operating in a particular sector. In this instance, the say offshore oil and gas sector, but it could be any sector, right? So, and let's say there's 100 at the peak of some massive boom, and now things turn awry and the underlying price collapses and people hand out pink slips and things are not pretty. That entire market can go down to 10 companies, right? But what happens is the assets don't go away. The assets of the 100 companies change hands. And typically what happens is the 10 companies that are left that have got strong enough balance sheets to handle it. And sometimes they just also have to go through restructurings as well, go through bankruptcy processes, you name it. But you'll end up with less companies that own all of the assets that existed before, 100% of them. Okay. So you have a concentration, another concentration, but it's a concentration at very, very low valuations. So I would say today we have this concentration at very, very low valuations in the energy space. On the flip side, we have a massive concentration in the S&P 500 and in the Mag 7 at much higher valuations, right? And so that's the structure of the market. And it's important for people to understand that risk side of things too. You know, you might not believe that my idea of buying oil and gas stocks is a good one, but certainly a lot of the capital that is invested by investors today is into the Mag 7. If you take the S&P 500, I think it was JP Morgan put out this this chart, and it was like a scatter diagram showing the relationship between returns on the S&P 500 and the PE ratio. And it was an inverse relationship. In other words, the higher the PE ratio, the lower the subsequent returns over the next 10 years would be, right? And the lower the PE ratio, the higher your returns over the next 10 years would be. Makes sense, right?
Yep.
Because if you're buying something cheap, it becomes more expensive, you get better returns. If you buy something expensive, it becomes more cheap and you get shittier returns.
There's more potential energy with, the lower the price.
100%. And so the interesting thing with that was that so the average return on the S&P 500 going back like 100 odd years is 10%, 10% a year. But that 10-year time frame is not consistent. It's never consistent. It massively outperforms and then it underperforms. And if you want to understand where to buy or like where you're at, it's down to PE ratios. It's one of the methods. Again, high PEs are predictive of a poor return over the next 10 years. In fact, they had just get this right now. So it was, if you bought the S&P 500 when it was, that's right, it was 23, PE of 23. If you bought the S&P 500 when it hit a PE of 23, the next 10 years, your return was between 2 and minus 2% every single time, no exceptions. Okay, so you have this historical precedent, right?
Yep.
You know that if the PE is 23 and you buy it over the next 10 years, based on history, without any exception ever, you would get a return of between 2% and minus 2%. Okay, so in other words, nothing for 10 years. Guess where we're at today? It's about 25.
Mm-hmm.
So Again,
There you go.
an average of 10%. But that now, if it was the other way around, you're not going to necessarily get 10% over the next 10 years. You get like 20%, right? That's just the way it works. So on average, people go, "Oh, just buy the S&P 500." On average, it does 10%. That's true. That's true if you live to be 100, right? And it doesn't really matter. But if you're sitting here and you know these cycles and you can see the pricing variance and you know that every time it hits 23 or above, your probability is 100% that you will underperform. There's a very simple risk measure. Do you buy the S&P 500? Yes or no? It's pretty simple. So I could take the same methodology and put it across any other asset class and do the same math and go, when do you buy it? What does it look like? And this is how we landed up with a portfolio like we have. You know, that's how we bought gold equities when everybody's going, why are you buying gold equity? Why would you want to buy gold? Why do you want to buy uranium? Why do you want to buy this stuff? And we're like, because this is why.
What about these mining stocks that don't even have PE ratios because their earnings are in the negative?
Yeah, so this is a very, very good point. You want to be, look, by and large, if you're a deep value investor, you're not going out and you're not looking to buy some development plays or some moose pasture in Saskatchewan that might have a deposit that can run 2,000% or be worthless. That's not our gig, right? Our gig is to look at profitable existing businesses. Okay, that's much easier for you to determine. Now, within that context, if you find a sector that is likely to perform well, and you are of the sort of mental mindset where you like to swing from the rafters a little bit, instead of going and buying large or not even large, but just companies that are say producers, you can go and you can buy these other things, explorers, developers, right? Buy a basket of them, and in a bull market, it's quite possible that you will do really, really well. But realize what you're doing. You're speculating because you don't know whether that company is going to make money or not. In fact, there's many times in any bull market where the price of the company goes up, the share price goes up, but they don't actually make any money. And they might not even find any resource, or they might find a resource, but they haven't got enough money to develop it, and yada, yada, yada. There's any number of things, but that doesn't stop the price going up. Why? Because human beings are emotional and they chase shiny objects, and those are that becomes the new shiny object. And I'm sure you've had, some people on your show who specialize in that, who talk about, some of these gold miners and things like that. That's basically not, by and large, not our gig. We're much more focused on sectors and where you can find companies that are actually profitable. Then it's risk mitigation for us.
Yeah, I mean, one thing I've got to give it to you guys is you always come up with these, I don't want to say weird, but like oddball sectors that no one's ever like thought of in the portfolio. So you go out there and you scour the landscape and you come back with all these deep value plays that, from the middle of nowhere. And, they're not just deep value for the sake of being deep value, but I mean, I've seen it firsthand in my own portfolio. These stocks, see multiples and gains in the process. So if you guys are interested in checking out the Capital Exploits Insider portfolio that Chris and Brad have constructed, there's multiple portfolios actually. There's a capital gains portfolio optimized for capital gains. And then there's a dividends portfolio as well. So, and a bunch of other cool features on the website. So we have a special $1,000 discount down below. In my case, it's pretty much the performance of the portfolio is pretty much paid for itself multiple times, many multiples of times. So I highly encourage you guys to, at the very least, check it out and consider it. So link is down below in the description box as well as the pinned comment. Chris, you and I mean, you mentioned some geopolitical tensions arising. It seems like things are relatively calm now. There's like this subdued peace supposedly in the Middle East. Based on the cycles, can we see peace break out, or are things set in motion that can no longer come to no longer come to an abrupt end until they fully play themselves out?
The answer, I think, largely comes down to historically, debt needs to be paid or needs to be written down, and that's not yet happened. And only when that transpires do conflicts subside. So, based on that, we will continue to see rising conflict. Unfortunately, I wish I, that's it's not my wish. That's just again historically that's what happens. And so until the debts are restructured or repaid, then we're unlikely to see the end of conflict, and that'll be both domestic and international. So I think the peace deal in Israel that's just been touted as a major thing now. I would be very surprised if that holds. I think that's a short-term anomaly. I don't believe that is likely to continue. Certainly, and then with respect to the Ukraine conflict, um, it doesn't. It's almost like all parties benefit from it continuing.
Yeah.
Okay, so like the West continues to benefit, A, because the deep state is in control and they want to continue funneling billions of dollars through that mechanism. Then you have Europeans who have an enormous debt problem and they have to solve that. And we're watching literally daily them rolling out different measures with respect to increasing the conflict with Russia. Russia for itself actually wants the conflict to continue. Why? If your enemy is the empire and you are a student of history, and certainly those in the Kremlin are very good students of history, despite what you might think of them, Putin at the helm of it is an unbelievable student of history. If you listen to his speeches, he can just talk for hours with no teleprompter in extreme detail on history. So he understands this. And so back to the question that I posed, which is how would you, if you were fighting an empire, how would you defeat the empire? Historically, there's only a couple of ways that you defeat an empire. Basically, you draw them out until they just bleed out. So it's to his benefit to have the conflict in Ukraine continue such that they keep throwing billions of dollars at it, provided it doesn't suck him down. And that's the balancing act. Now, on top of that, it also benefits him to have many other conflicts taking place. To some degree, it benefits him if the US goes after Iran. The ideal, probably for Russia, and even actually, ironically, Iran, is for the US to attack Iran, but they need them to have a ground invasion because that will really suck them in and will drain them. And there's no ways they can win a ground invasion. No more than they could win against Afghanistan, who were a piss-poor bunch of goat herders in sandals, and they couldn't beat them. There's no ways they'll beat the Iranians on home turf. Again, geography, a number of things.
Just because of the terrain alone, it's a very mountainous region. The Iranians have the high ground there, and obviously, it's much more difficult to maneuver around as an invading force.
Mm-hmm. And they're very technologically advanced with respect to drone warfare, which is another one. Coupled with the fact,
so much so that I believe it was Russia was importing or buying up these Shahed Iranian drones to use in Ukraine. Right.
Yeah.
So they were, So
and that's the other thing. So you have, the non-Western empire, if you will, coalition, if of Iran, Russia, and China, all of whom actually benefit from an ongoing conflict. It's just they just need to manage that conflict such that it doesn't destroy them themselves. But they would understand that that is how you destroy the Western empire, is by attrition, right? So it would also benefit them if they invaded Venezuela and they could wage a proxy war there and just keep having Americans funneling more billions of dollars into a war in South America, as well as a war in Ukraine, as well as a war in Iran. The more that they suck them in, the greater their ultimate probability of success. Because the United States Army and military is so powerful, you can't beat it. The only way you're going to beat it is by multiple attrition wars. So back to the point, at this point, it's like all parties actually benefit from continued conflict.
Yeah.
And from the US side, you go, why would they continue to do that? Why? Because the deep state doesn't give a shit. The head of Lockheed Martin and people like that, there's always hubris at the end of an empire. And that's true of their politicians themselves, most of whom are simply podium donuts and don't actually make the decisions. But there's hubris, and there's also just the good age-old who profits, right? If you're making billions and billions of dollars selling weaponry to any and all of these conflicts, you just keep doing it.
Yeah, it's like a boxing match where you're trying to wear out your opponent by taking him into the latter rounds, and you're just playing defense the entire time. So by round 8, round 9, whatever, they're so gassed out that you can go for that knockout blow.
Yeah, that's it.
Interesting stuff. Well, Chris, my friend, anything else you want to talk about before we wrap up here? I think we've gotten pretty much all the newsworthy items out the way. Here's one thing. Actually, just one more thing just popped in my mind. I was looking at these prices. If we do see rising energy prices, won't that put a headwind on these precious metals and metals mining stocks as part of their input costs?
It could do, but okay. So keep this in mind. The entire size of the precious metals market is an absolute fraction of, just say, Nvidia, let alone the Mag 7, let alone the S&P, let alone the S&P plus the NASDAQ plus the Dow plus the Russell. So we're talking about very small weightings of capital both in the precious metal space as well as in the energy space. Energy is like 3% of this S&P, maybe 3.5%, something. It's tiny. It's insignificant. And so that metric was what you're just referring to, so that people understand it, is that as the cost of energy goes up, obviously that's a huge impact on mining, right? Because it's one of the biggest operational expenditure items in your operating costs is energy. So it can have an impact on the profitability of any mining operation, for sure. That's true. However, a bigger force, and I'm not saying that a bigger force here is that you have a capital rotation. People won't even care about whether something's profitable. Now we do, we because that's a risk mitigation tool for us, right? Is to buy things that actually can survive, right? And we don't actually need to have this other catalyst. But if we get that capital rotation, and I believe we're already in it, we're watching it with gold, silver, platinum, palladium, even copper now. Like, you're a portfolio manager sitting on Wall Street and you got to allocate 5% to this, and it's like a few billion, it's like 50 billion or something in total market cap. Like, you buy what's there. You don't even care about whether something's profitable or not. And that's typically what happens. So it's true that there can be an impact on the operational costs from rising energy prices. But again, if demand just keeps pushing higher, it just keeps price punching higher. So they'll move lockstep, and you'll have pullbacks and all this other stuff. But I think we're on the cusp of a big energy move. I really do.
Yeah. Well, all right, Chris, it's been a pleasure having you on, as always, my friend. Anything else you want to mention, talk about that we didn't get into before we wrap up here?
Not really. I mean, there's a whole bunch of other stuff we could talk about. Emerging markets look really, really interesting to us as well.
Oh
Um,
yeah, yeah. I mean, I don't want to spoil it, but you guys did put out a trade alert a couple of weeks ago on an emerging markets trend. Very interesting. I've seen the setup. It looks amazing,
yeah,
quite frankly. So
yeah.
go ahead.
That's it, really. That's just keep your eye on emerging markets. It looks like something's happening there. Certainly, it's been through like a brutal 15-year bear market,
Mm.
um, and that's exactly the type of setup that is formative in creating asymmetry. Because everybody's chasing AI and um, all this sort of stuff. Yeah.
All right. Well, Chris, thank you so much for your time, my friend. Guys, if you want to take advantage of the $1,000 coupon off of Chris's newsletter and get access to all of the stocks in both capital gains portfolio as well as the dividend portfolio, you're going to find some stuff in there that you would have never found out elsewhere. So I can't recommend it enough. And Chris, I mean, you guys just gave out a new trade alert the other week on an emerging markets pick as well that I think you guys would want to get in on the action with as well. So I'm not going to spoil it, but if you are interested, the link is down below. Highly encourage you guys to check it out. I've been a member for 5+ years. I reached out to Chris to start this partnership. It wasn't the other way around, just because of how much I believed in the product. So it's happening, guys. Precious metals are moving. All we're waiting for now is energy to catch back up. Is this going to be the real deal when it comes to the commodities bull market? I guess we'll see, but it's looking more and more likely each day. So
Buckle
take
up.
it, buckle up, and take advantage of it while you can. So if you enjoyed this podcast, drop us a like and comment "Go Chris Go" in the comment section. If you agreed or disagreed, either way, do let me know, because I do in fact read the comments. So drop me your thoughts down below. I'll try to reply to a few of them. I can't get to all of them actually. You guys are like starting to reply, and I thank you for it in the hundreds and sometimes in the thousands of replies. So I can't get to all of them, but I do make it an effort and in a condition to read all the comments. So at the very minimum, you'll know that I've read your comments. And subscribe to the channel so you don't miss an episode. And by liking, subscribing, commenting, doing all the YouTube stuff, you do help us in boosting this channel and this video in the algorithm. So much appreciated. A little bit does go a long way. And check us out on Substack as well, capitalcosm.substack.com, to get access to all my stuff early and ad-free and uncensored. So with all that said, thanks for watching, guys. I will catch you later. Bye.
Thanks, guys.